Welcome back to the Deep Dive. You can forget reading 80 pages of transcripts because, well, we've already done the work for you.
We have indeed.
Today, we're cracking open Worthington Enterprises, ticker 1WR, and diving into their fiscal 2026 second quarter earnings call.
And our mission, as always, is to find those key results, the big strategic moves, and, the nuggets of insight from management that really matter.
Right. And for this one, it feels like the big picture is all about resilience.
It is. I mean, this is a company that's actively reshaping its entire portfolio, all while juggling a, let's say, very cautious macro environment.
And the results seem to show that their internal execution is, for now at least, winning out over those external headwinds.
Exactly.
Okay, so let's start with the headline numbers for Q2. Top-line sales looked really strong.
Very strong. Net sales hit $327 million.
Which is an increase of over 19% year over year.
Right. But here's the crucial part. Even if you strip out the contribution from their big acquisition, Elgin organic growth was still 10%.
10%? So that volume strength isn't just something they bought.
No, it's coming from the core business. And that leads to the earnings side.
Which gets interesting. Adjusted earnings per share landed at 65 cents. That's up from 60 cents in the same quarter last year.
And adjusted EBITDA followed right along, up to $60 million from $56 million.
Management really seemed to hammer this point home.
They did, because it marks a pretty critical milestone. This is the 5th consecutive quarter of year-over-year growth in both of those adjusted numbers.
5 in a row. So that's not random. That's a pattern.
That's operational discipline paying off.
That said, we do have to talk about the divergence because the GAAP EPS number, the official number, was noticeably lower at 55 cents a share.
It was.
So for anyone listening, why should we focus on that 65-cent adjusted number instead of the lower GAAP figure?
Well, that 10-cent difference really came from unique non-operating items. In this case, it was related to a divestiture within one of their joint ventures.
It's an accounting noise, basically.
It's mostly non-cash noise, yeah. Portfolio cleanup. When you're trying to track the actual health of the underlying business, the operations, the margins, the adjusted figures, just give you a much clearer picture.
And looking at the trailing 12 months, that operational health really seems to shine through. TTM adjusted EBITDA is now at $284 million.
And the margin is approaching 23%. Just a year ago, it was at 20%. That expansion is probably the clearest signal for the market.
Right. It tells you their strategy is working.
It's working. Pricing, optimization, M&A, it's all driving profitability higher.
Okay, so let's look at the engine behind that strategy. They call it the Worthington Business System. 3 pillars: innovation, transformation, and M&A.
And they definitely led with M&A this quarter. The big news was the newly planned acquisition of a company called LSI.
Tell us about LSI.
So LSI is a leader in a very specific niche. They make metal roofing clips, components, and specialized retrofit systems. Highly engineered stuff.
And the financials here just jump off the page. LSI did about $22.4 million in trailing 12-month adjusted EBITDA on just $51.1 million in sales.
That's right. You're talking about an absolute margin machine.
And here's where it gets, I think, really interesting. The acquisition price is expected to be around $25 million.
Correct. Closing in January.
Hold on a second. They're paying $25 million for a business that's generating $22.4 million in EBITDA. That's a multiple of barely over 1.
It is.
How is that possible? A niche market leader with margins like that? It should cost a lot more. What are we missing here?
Well, management was pretty clear on this. The deal is instantly accretive to margins, EPS, and free cash flow.
The price.
The low multiple likely reflects a few things: the highly specific nature of the assets, maybe some owner motivation, and the fact that it's a very streamlined business that fits perfectly into their existing portfolio.
They called it a classic Worthington fit.
Exactly. They believe the cultural alignment lets them capture value others might miss. It's a niche market, it's retrofit driven, so it's resilient, and it has high switching costs. It's a huge strategic statement.
Okay, so that's the new acquisition. But what about the last one, Elgin Manufacturing? That's more on the transformation pillar.
Right, the HVAC components business. Elgin contributed about $25 million in sales in the quarter.
But management did say that the integration efforts, safety upgrades, new equipment, it actually limited their ability to meet demand.
It did, and it dinged their consolidated gross margins a little bit.
Should we be worried about that drag?
I don't think so, no.
Yeah.
Management framed this as a necessary short-term cost for a long-term investment. You take a small margin hit today to unlock way more efficiency and capacity tomorrow.
Okay, that makes sense. Short-term pain on the industrial side. But let's flip the lens. Where are they seeing immediate high-margin wins?
That takes us straight to the innovation engine on the consumer side.
Consumer product sales were $120 million, up 3%, but that's not the real story.
No, the real story is the market expansion. We're talking about a 63% growth in their overall store count through new placements.
63%, that's phenomenal.
It's fantastic execution. And the big win they highlighted was their balloon time products expanding to Costco stores nationwide.
Wow. And that's on top of CVS, Walgreens, Home Depot.
And management's insight was key here. They see these products as affordable, resilient items that often replace more expensive experiences. So it sort of shields the segment from broader consumer caution.
That's some good defensive positioning. What about building products? The organic story there was also really strong.
It was. Excluding Elgin, organic growth was 16% year over year, which is frankly much higher than I would expect it given the construction data we've been seeing.
So what's driving that? Is it just the move to environmentally friendly refrigerants?
That's part of it, for sure. It's helping drive volume. But the real surprise, the innovation story, came from their large water tanks.
The ASME tanks.
Yes. They highlighted a ton of new success supplying these massive tanks for cooling data centers.
Data centers.
Yep. That's generated new orders and opened up what looks like a significant long-term growth area. They're finding these pockets of hyper-growth.
So innovation is driving the top line, but what about cost control? SG&A expenditures declined by a massive 320 basis points as a percentage of sales.
It's a huge number.
But is it sustainable, or did they just cut into muscle?
It seems sustainable. They frame it as efficiency gains from the company's separation, not just slashing budgets. And the real proof is in the cash flow.
Right. Operating cash flow was $52 million.
Which generated $39 million in free cash flow. And their trailing 12-month free cash flow conversion rate is now at an impressive 96%.
For anyone tracking industrials, a 96% conversion rate, especially when you're spending on modernization, that is a huge testament to their discipline.
It's almost unheard of. And it ties right back to that transformation pillar. They still have about $30 million of modernization capex left to spend over the next 3 quarters.
So what does that spend get them?
Better automation, less waste, more capacity. But the key thing here is the timing. The full benefits, the full payoff from that investment are targeted for fiscal year 2027.
So the biggest payoff is still a few quarters out.
It is. This is a long-term story.
Okay, that sets a great timeline for investors. Let's shift to the external factors now, because management was bullish on internal execution, but very cautious on the macro.
Really cautious. But before we get to the headwinds, let's just touch on that data center exposure again.
Right. It's surprisingly broad. Water tanks, Wave, Clark-Dietrich, Elgin, even the new LSI deal.
It's pervasive, but they did provide some crucial context. While it's growing fast, in aggregate, it's still less than 10% of sales for any of those businesses. So it's a great driver, but not a material one yet.
Got it. Which brings us to their joint ventures. They provided a healthy $34 million in dividends, but the performance between them was starkly different.
Absolutely. It really illustrates the macro tension. You had Wave, which continued its strength, contributing $26 million in equity earnings.
And Wave is more repair and remodel focused.
Exactly. Stable end markets like education and healthcare. Very resilient.
But the flip side is Clark-Dietrich.
And that's where the weakness hit hard. Clark-Dietrich contributed only $4 million in equity earnings, down from $10 million a year ago.
What's going on there?
They are suffering from what you might call the new stadium curse.
The new stadium curse.
Well, management cited a challenging new construction market and more competition. Clark-Dietrich is having to compete on these huge lower margin projects, stadiums, hospitals, some data centers, where they win the volume, but they lose the margin.
So they're busy, just not as profitable.
Precisely. The outlook there is pretty tempered. Management expects performance to be, and I quote, no worse than flat, sequentially.
Okay, so that contrast is critical. Last piece of the macro picture. How are they handling tariffs and supply chain issues?
They actually see themselves as a net beneficiary of the current tariffs. They're predominantly a domestic company with only about 7 or 8% of revenues sourced overseas.
So it shields them and can even give them an edge against foreign competition.
Right. And they're controlling costs by pressuring suppliers, optimizing their own supply chain, and using targeted pricing actions.
Okay, so what does this all mean? It's time for the "this is not financial advice" segment. our outrageous but plausible trade idea based on the call.
The core conflict driving this business right now is that deep split in the construction market. You have high margin, stable retrofit on one side and depressed competitive new construction on the other.
So how do you play that split using Worthington?
The idea is a paired trade. You go long Worthington Enterprises, ticker WER. You're betting on that resilient, high-margin defensive portfolio they're building.
So LSI, Wave, the consumer segment.
All of it. And at the same time, you establish a short position in some of their publicly traded peers who are heavily exposed to that struggling new commercial construction cycle.
The same pain points we just saw at Clerk Dietrich.
Exactly. You're basically betting on Worthington's pivot away from the cyclical hammer of new builds.
And the market might be underappreciating that pivot.
I think so. It may be underappreciating the value from that LSI deal and that incredible 96% free cash flow conversion. This trade captures Worthington's specific upside while hedging against the broader macro weakness.
A compelling pitch. So, to summarize the quarter. First, strategic M&A is aggressive and accretive, with LSI as the prime example.
And second, operational discipline is off the charts. The SG&A cuts, the SDF conversion, they're defending and expanding margins in a really tough environment.
A great summary.
And here's a final provocative thought for you to take with you. They still have $30 million left to spend on modernization, with big payoff coming in fiscal 27. How much of that future value is the market already pricing in, especially when you consider their balance sheet? Their net debt to trailing EBITDA is only 0.4 times. They have a ton of dry powder. Are they done with M&A, or is that low leverage a signal that the next, maybe even larger acquisition is right around the corner?
Food for thought indeed. That's all the time we have for this deep dive into Worthington Enterprises. Thank you for joining us.
Thanks for having me.
We'll see you on the next one.